Hi, everybody. This is Gary Dean, and this is our weekend video report for Sunday, April 17th, 2016. Not really a whole lot what took place on Friday. It's really, I'm not going to add anything new to what I've been saying really for the last couple of weeks. The market is very, very overextended. Doesn't mean that things have to drop right now. But it doesn't make the alongside any safer. So it could turn at any day, and it would make perfect sense. A lot of the internals as well as the technicals are screaming for a pullback that could be significant. We could be making some type of intermediate term top, but we're really, we just want to monitor things right now, and seeing a hard drop at any point, like I said, would make perfect sense. So taking a look at the internals, we have the advanced decline that is at highest levels that it's really ever seen. And the VIX is at support, as we have the S&P that is at resistance. So we have the bullish divergences. Another reason why I don't believe that the bull side or the long side is safe right now. The put call ratio is still at very, very low levels right now. And which one is this one? This is the bullish percent. Excuse me. That's at levels, really, really high levels that we've seen significant pullbacks take place from. So internals are saying, just be very, very cautious right now, even though price has not really reacted to any of these overextended indicators as well as the bearish divergences. So daily chart, you can see we have the bearish divergences. It's been taking place for a very, very long time. That's why I'm saying, a hard drop at any particular point from now until next week sometime would make perfect sense. This move right here is reminding me a lot of this one. So if it's going to follow it in a fractal pattern, we would expect a drop to come someplace down into the 1990 area before coming back up to test the highs again, and then from there collapsing. We are still trading within this channel right now. If it's going to hold true, then we could expect the next move to come someplace down into the below the 1800 or below these levels right here. So we're at resistance. We have bearish divergences. We're within the channel. Again, it just, things are very, very, you can't be relaxed right now if you're on the long side, because like I said, things could turn at any particular day right now, and it would make perfect sense. So here we have the 60-minute chart. Again, bearish divergences. Just a 23% retracement brings us down to the 2022 level. We have not seen a drop like that since this rally started going back in February, and we haven't really, each drop that we've had has been just an intraday drop, and then we've marched back higher. So we, you can see that the rate of change is slowing right now, where this was the biggest move, this was the second biggest move, third, and you can see each new high is just getting less and less extreme. So we're at the resistance. We just a 23% retracement brings it down to the 2022. A 38% retracement, which is, really the typical would be the 38 or 50% or even 62% retracement after a move like this. You can see why the next, the target areas are the 1981, 1950, and then all the way down at the 1916. So the bulls have not been tested at all, and each test has been intraday. So when you get a closing, red day that's tough, you may be seeing people run for the hills just because, they haven't been really used to having to defend anything on a daily basis. Everything has been intraday. So, again, very overextended bearish divergences. Really what the bears need to do is push it through to 2041. That will get a reaction trade down to the 2022. Really, the line in the sand, or bull bear line, would be the 2009. Below that, that's when you start expecting these levels to get hit. But until the the bears can push it through some support levels, the bulls remain in control. 15-minute chart, again, bearish divergences, kind of neutral on the momentum, But it's just the daily and the 60-minute charts that are, just so extended right now that I'm not sure the short-term charts are really going to make that much of an impact. You can see on the Dow Jones that we've gotten above the 78% retracement, and if we look at the Qs, this was my target. You can see it hit it. This is one of the reasons why I believe the markets were holding strong, was the Qs or technology never made it to the 78% retracement. So we know that the Qs hit it. We know that the Dow hit it. And if we look at the S&P, we know that made it above it as well. So all indexes are now, at that 78 or above retracement level. That is very typical for counter trend rallies to go there, because what it does, it convinces everybody that the original trend, which was down, is over. But if you notice, we're yet to make any type of higher highs right now, and we've made lower lows, so the trend remains down. So right now, like I said, until price reacts, the bulls remain in control. I would not be complacent right now, because we've seen this market when they pull the rug out, it just goes straight down. So don't know when that's going to play out. Like I said, it could happen any day. It would make perfect sense. Maybe they extend it for next week, but it's it's just definitely a place that you don't want to be complacent, because we're probably at some of the most oversold levels that we've seen since this 2009 rally started. So it is you have to be very, very cautious right now. So with that, let's see what plays out tomorrow. Enjoy the rest of your weekend, and I'll talk to you guys in the morning.